Hi, everyone. Uh, Great to be with you today in a virtual form. I think we must try and make it as interactive as possible. So we'll see how to do that. Right now, I can't see the menu on the top. I hope if you ask me questions, I'll be able to see that. Can everybody hear me? Anyway, I can get to know that.
Yes, we can definitely hear you.
Everyone can hear?
Yeah, we can hear.
Okay, now that menu has come. All right. Good evening, everyone. Since the time is very short, let me start right away. Tell me, how many of your companies are sales-driven companies? By sales-driven, I mean you ask a reasonably senior person from a sales-driven company, do you know your top line? You ask him this question today morning, he will give you the number up to last evening. Sales-driven organizations monitor top line on an online basis. How many of your companies are sales-driven? Not important. Let's assume you are. You ask a senior person of a sales-driven company, do you know your top line? He said, of course. Ask him, do you also know your bottom line? Bottom line is usually a black hole. So much so, very often business owners don't even know whether they've made a profit or a loss till the accounts department finishes its work. Now, this I find scary. Folks, are we in business to generate top lines or bottom lines? Business is all about bottom line. Now, top lines you are constantly aware of, and bottom line you are clueless. You know, I genuinely know entrepreneurs. 31st March year comes to an end. Next 2, 3, 4 weeks, accounts department brings the first draft of the profit loss account and balance sheet to the managing director. The MD eagerly looks at the top line. Let's put some number. Let's say 100 crores. But that he knew. They were monitoring it every day. Then he looks at the bottom line. Is it plus or minus? Let's say he finds a figure of 12 crores. Heaves a sigh of relief. Great, we made a profit. Wonderful. A couple of days later, the same accountant comes back and says, sir, a bit of a problem. You know that idiot accountant? You put an extra zero over there. The profit is not 12 crores, sir. It's actually 1.2 crores. And the MD goes, oh my God. Now, why did he go, oh my God? Because he was told 12 crores. Had he been told 1.2 day one, he would have been okay. I mean, this is scary. I think as aware business people, aware CEOs, aware managing directors, aware entrepreneurs, you must not only know your company's top line, but by looking at the top line, you should have an idea of your bottom line. And when the accountants give you this information, which can be weeks later, because they need to do a lot of work, they need to do a lot of data collection. When the accountants give you that number, it should only be meant to verify what you already knew. I wish we had the luxury of more time. I would have taught you a few techniques, whereby looking at the top line, you should know your bottom line. But today, let me see how much I can take you through. And there's a message I have in mind that I want to communicate by the end of it. But tell me, historical data you always know, right? So let's say last year, your company's top line is 100. Last year, you know top line and bottom line, right? So last year, your bottom line was 20. Current year, you are monitoring top lines, and the top line has become 200. Can you guess the bottom line? Last year sales 100, profit 20. This year sales 200, profit. I'll give you 3 options. Can it be 40, less than 40, or more than 40? Which school of thought are you? I wish it could be interactive and I could get some answers. Any case, folks, if sales of 100 becomes 200, and if profit of 20 becomes less than 40, I think some head should roll. Some people should not be around. Somebody is bungling up badly. So right now, I am in agreement with those of you who said, in case you said, that if 100 becomes 200, I can see some messages now, that if 100 becomes 200, profit of 20 will become more than 40. How many of you said that? Okay. Now to those of you who said for 20 can become more than 40, my next question is, how much more? Do you think if 100 becomes 200, that 20 can also become... Oops. Okay. Can it become 60? In case there is somebody who said 60 is possible, can it become 80? And in case you said 80 is also possible, my next question would be, can it become 100? Or can it become 120? Now I've run out of space. Folks, the answer is, if sales of 100 becomes 200, profit of 20 can become 40, can also become 60, even 80 is possible, even 100 is possible, even 120 is possible, beyond 120 is not possible. I'll soon give you the logic, it's very, very simple. But before I do that, I want to ask you, out of these 5 options given to you, 2 are theoretical, 3 are practical. 2 are remote possibilities, 3 are in the realm of reality. Can you tell me which 2 are remote possibilities? In case you said 100 and 120, I would have to say, no, that's not the right answer. Yeah, Vishal, you said 100, 120. Rahul said 40 and 60. That's also not right. And the correct answer is, if 100 becomes 200, 20 becoming 40, and 20 becoming 120 is possible in theory. The reality is going to be between these 2 extremes. Now I'll give you the logic, very, very simple logic, folks. When sales of 100 becomes 200, when will profit of 20 become 40? The moment I said sales is 100 and profit is 20, what I have effectively told you is that my cost is 80. Now when 100 becomes 200, 20 will become 40, only if 80 becomes 160. That is not going to happen. When your sales will double, every cost will not double. Similarly, when 100 becomes 200, when will 20 become 120? That last column, that will only happen provided 80 continues to remain 80. That's also not going to happen. Neither will all costs double, nor will no costs double. And therefore, the reality has to be squeezed between these 2 extremes. Now tell me, where did I get this information from, that column 1 information? Obviously, the column 1 data I must have extracted from a financial statement called P&L, where that sales figure must have appeared on the right-hand side, and that 80 must be the total of the left-hand side, which must have included items like materials and power and salaries and commissions and rent and many, many more items. And the total of that must be 80 and profit must be 20. This is what I condensed and gave it to you in the first column. And what question did I ask you? Question asked was, what will happen if 100 becomes 200? Folks, tell me, if sales of 100 becomes 200, what is the possibility that for 100 sales, you were consuming raw material of 45? What is the possibility that for 200, it can become 90? Strong. For 100 sales, your power consumption was 5. If you sell 200, can your power consumption go up to 10? Perhaps. If for 100 sales, if your salary bill was 9, for 200, will you start paying 18? No. It might become 10 or 11 or 12. Or If the data was not for year 1 and year 2, it was for month 1 and month 2, then chances are 9 could even remain 9. People who brought you business worth 100, you gave them a commission of 10. If they bring you business worth 200, will you pay them 20? Yes. Commission, like brokerage, is proportionate. And when your sales was 100, your rental was 11. Because you sell 200, will you pay 22 rent? No, rent will remain 11. What I'm trying to tell you is, if you start studying all your heads of expenses, nature-wise, you are going to discover against every head of expense, you will be able to write either the letter V for variable or F for fixed. All your costs can be broken up nature-wise into two types, variable and fixed. And folks, now when I tell you my sales is 100, my cost is 80 and my profit is 20. Now when my sales become 200, can you guess my profit? You should have a counter question for me that, Anil, if you want me to guess your profit, please tell me first, what is the breakup of that 80? How much of 80 is V and how much is F? And only if I had told you, entire 80 is V, there is no F, which is not going to happen. Only then, when 100 becomes 200, that 80 will become 160 and your profit will become 40. But what if your breakup looked like this? Your 80 was made up of 60 variable and 20 fixed. Now it's easy to guess the profit. When 100 becomes 200, that 60 variable will become 120, that fixed 20 will remain 20, and the profit will become 60. And what if the breakup was like this? And if it was like this? And only if it was like this? Question I want to ask all of you. Can you please tell me, when do organizations make more profit? When the fixed costs that they have to bear are less or fixed costs are more? Lower the fixed costs, higher the profit, or higher the fixed costs, higher the profit? Can I see some answers, please? Anyone? Folks, in case you said lower the fixed cost, higher the profit, I've always said finance is a common sense subject. And every time you give an answer, my counter question to you is, have you given me a common sense answer or have you given me an accounting answer? Those of you who feel that lower the fixed cost, higher the profit are giving common sense answers. I mean, higher fixed cost mean, I'm not suggesting you go and double your salary. Your profit will fall. If you pay more rent, your profit will fall. But right now, if you look at the table, it tells you higher the fixed cost, higher the profit. When fixed cost was 0, as in case of column 2, when sales of 100 became 200, your profit of 20 became 40. But when your fixed cost was 20, profit became 60. When your fixed cost was 40, profit became 80. When your fixed cost was the highest, as in the last column, your jump in profit was the most. Lower the fixed cost, higher the profit, or higher the fixed cost, higher the profit? Rinku Shivani, is a very smart person, I know that, and therefore he's given the right answer. He says higher the fixed cost, higher the profit. Absolutely right. So folks, what is my suggestion there? Is it my suggestion that you double your salary tomorrow? No, profit will fall. Is it my suggestion that you call up your landlord and say, how much rent are you charging? Can I pay a little more? Don't be foolish. All common sense thinking tells you lower the fixed cost, higher the profit. And how do I mean higher the fixed cost, higher the profit? Let's imagine the last 5 columns are actually 5 different companies. This is A, B, C, D, and E. Imagine all 5 of them, the first column, all 5 of them had a sales of 100, a cost of 80, and profit of 20. But what was the difference between these 5 companies? The difference between them was the breakup of that 80. In the case of A, the breakup was entire 80 was variable, no fixed. In the case of B, the breakup was 60-20. In case of C, 40-40, 20-60, and 0 and 80. Between A, B, C, D, and E, who had the least fixed cost? A. Who had the highest fixed cost? E. Next year, all 5 of them worked twice as hard. And all 5 of them managed to double the turnover. Folks, when A's turnover doubled, his profit doubled. When Mr. B's turnover doubled from 100 to 200, his profit trebled from 20 to 60. When C's turnover doubled, profit quadrupled to 80. In case of D, it quintupled to 100. In case of E, the jump was the max. Between A, B, C, D, and E, who has the highest fixed cost? E. Whose profit went up the most? E's. Moral of the story, higher the fixed cost, higher the profit. Then why am I saying don't ring up your banker? What kind of interest are charging me on loan? Just about 12%. Can I pay 15%? Don't do that. When common sense thinking tells you lower the fixed cost, higher the profit. How do I mean higher the fixed cost, higher the profit? Between A, B, C, D, and E, who has the least fixed cost? A. Who has the highest fixed cost? E. But have you noticed the cost of all 5 is 80? E doesn't have a higher cost. E has a higher fixed cost. Folks, if you unilaterally announce a jump in salaries or offer to pay more rent, your cost will go up, your profit will fall. Cost should not go up, fixed cost should go up. Now, how can fixed cost go up and cost not go up? That can only happen if you start swapping a variable cost with a fixed cost. Let me give you a graphical presentation which might make a little more sense. Many of you might be technical by nature. Tell me, what does a graph look like when all your costs are variable? Oops, how did this happen? What does the graph look like in case all your costs were variable? If in case of such situations, if your sales goes up, your cost will go up in the same proportion and your profit will go up in the same proportion. 3 linear lines. In such situation, had I asked you, sales 100, profit 20, sales 200, profit has to be 40. If your sales goes up by a 10%, your profit will go up by 10%. Suddenly it stops moving. And if sales goes up by 100%, profit will go up by 100%. This will happen provided all your costs are variable. But folks, what happens when there is a fixed cost in your costing structure? Fixed cost graph looks like this. Fixed costs don't remain fixed forever. Fixed costs also go up, but when fixed costs go up, they go up with a jerk. So it's a step graph. So in this phase, while the fixed cost doesn't go up, in the initial part of your business, if your fixed costs are higher, there will also be phases where your sales revenue doesn't even cover the fixed cost. That is the phase where businesses make a loss. But as your sales starts moving upwards, you first reach a point called the break-even point. And beyond that, if your sales graph continues to move up and cost being fixed doesn't move up at all, this gap between income and cost becomes wider and wider and wider. This has got a name in finance. Some other day we'll have a separate session on this fascinating area of finance. This in finance is called the leverage effect. Sorry. This is called the leverage effect. Right now, all I want you to keep in mind is, what does leverage denote? Leverages denote a disproportionate impact on the bottom line due to a certain increase in top line. And what I'm trying to communicate to you right now is, if you wish to enjoy the benefit of leverages, that means if you wish to enjoy exponential growth in your bottom line, it is essential that you have fixed costs in your costing structure. If your costs, all your costs are variable, you will never get a disproportionate increase in profit. Profit will only grow proportionately. And in order to enjoy the benefit of leverage, like I said, don't invite fixed costs because profit will go down. Try and exchange what was a variable cost with a fixed cost. Of course, remember this session is about making profit in difficult times, cost management strategies for difficult times. These are tough times. This strategy is not meant for happy days. What does happy days mean? Sorry, this strategy is meant for happy days when sales are going upwards. In tough days, what should you do? You see, the beauty of fixed cost is as the sales moves up, cost doesn't move up, and therefore profit moves up faster. But what if sales starts falling, as in difficult times? In such cases, do the reverse. Wherever possible, exchange a fixed cost with a variable cost. Right now, let's understand the implications of each thing, and then we'll see what strategy to use. So in happy days, swap a variable with a fixed cost. In tough days, swap a fixed with a variable cost. If your finance management is dynamic, you will probably get the best of both worlds. Now, your question in your mind is going to be, which costs can be swapped? All cannot. For example, your raw material can never ever become a fixed cost. It is bound to remain a variable cost. But folks, next time you want to make a new product and you're having an internal debate, what do we do? Should we make this product in-house or should we outsource it? One of the arguments to be taken into account is, if you make that product in-house, there will be an element of fixed cost. However, if you outsource, it will be purely variable cost. Let's imagine the market is booming. There is lots of business to be taken. What you really need is a team of live wire sales guys. So you are planning a recruitment campaign. You are trying to figure out, how do I reward these new recruits in terms of salary versus incentive? Should you pay them a higher salary and a lower incentive, or should you pay them a lower salary and a higher incentive? I want you to understand, salary is a fixed cost, incentive is a variable cost. Maybe you'd like to study your industry, find out within your industry which company pays the highest salary, and then come up with an advertisement, recruitment advertisement saying, we are offering a salary which is 100% more than the highest paying company in my industry, but no incentive. Now, what's going to happen if you pay a salary as ridiculously high as 100% more than anybody else? The best talent of industry comes to you. This best talent takes your sales graph moving upwards, but it has come accompanied by a fixed cost. It is a genuinely win-win situation. Let's imagine you're planning an expansion. You are trying to figure out, where will the next tranche of money come from? You have two choices. You can either go to a financial institution and raise money by way of debt, or you can go and raise money from equity, maybe by way of a public issue of shares. I want you to understand, when you raise money by way of debt, the cost is called interest. When you raise money by way of equity, the cost is called dividend. Between these two, one of them is variable, the other one is fixed. Which one is fixed? Interest. Which one is variable? Dividend. Now, according to your situation, you got to make such choices. In other words, what I'm trying to tell you is, in happy days, you can resort to funding your expansions by borrowed money because you want higher fixed costs. But in tough days, if you're raising money, you'd rather go in for equity. Now, let me give you a little more insight into what I said. Just now, I told you that all your costs can be split up between two types, variable and fixed. In fact, I will urge all of you, you all receive your financial results in the form of a P&L account, an income statement, which has got incomes and expenses. I'm urging you, get into the habit of also asking for data that those expenses should be split up into variable and fixed. And if you do that, it's not an easy job. You might need to put in some effort. You'll have to dig deep into it, identify costs as variable and fixed and so on. But now your profit becomes a function of sales, less variable cost, less fixed cost is equal to profit. Let's take an example. We can take any easy example. Let's say somebody is manufacturing furniture. Can you give me one example of a variable cost in the manufacture of furniture? Let's say wood. Let's imagine this person consumes, for every table made, 100 rupees worth of wood. Give me an example of fixed cost. Since I can't hear you, chances are sometimes people tend to say, machine is a fixed cost or something. Please remember, when I talk about cost, I mean the expenses side of P&L, not the asset side of balance sheet. So machine is not a cost at all. It's an asset. So an example of fixed cost would be, let's say, rent. This person hires a room and pays 10,000 rupees rent. Now let's imagine this person makes just one table. What does one table cost this person? The variable cost of one table is 100. The fixed cost is 10,000. So the entire fixed cost will have to be borne by a single table. So the cost of one table would work out to 10,100. And if this person wants to make a profit, he will have to price his table at higher than 10,100. And then one realizes that selling price is not in your control. Selling price is dictated by competition, by market. And if all his competitors are selling tables similar to his, let's say for 250 rupees, then this person realizes I will also have to price my table at max 250, maybe less, but not more. So let's say this person also decides to price his table at 250. Now, folks, his top line is 250. Can you tell me the bottom line? Bottom line obviously will be 250 less 100 less 10,000. But 250 less 100, sales minus variable cost, has also been given a name. I'm sure many of you are aware of it, but in case you are not aware, in case you're not familiar, then the earlier you familiarize yourselves with this term, the better. It is perhaps one of the most important words in the costing dictionary. Sales minus variable cost is called contribution. So what's the formula for profit? Profit is sales less variable cost is equal to contribution. Contribution less fixed cost is equal to profit. Fair enough? Let's complete the table. Sales of one table is 250. Variable cost is 100. Contribution is 150. Less fixed cost of 10,000 gives you a bottom line of 9850 negative. This entrepreneur comes to you for advice. Guys, I'm making a loss. Can you give me some advice? What should I do? Obvious answer is you're making a loss because you're making and selling one table. Make more. He listens to you. Let's say it doubles his output to 2. Sales becomes 250. Variable cost is 200. Contribution goes up to 300. Fixed cost is still 10. And your bottom line becomes negative 9700. So it takes a quantum leap and makes, let's say, 10 tables. Sales will become 2,500. I suggest along with me do your mental maths so that you are involved in the example. Your variable cost will become 1,000. Your contribution will be 1,500. Fixed cost is still 10,000. And the bottom line is still a negative 8500. Now this person says, I would like to know, when am I going to break even? I want all of you to watch this table carefully. And can you create a formula for break-even point? Tell me, why is this business making a loss? This business is making a loss because sales less VC is equal to contribution. Contribution less FC is equal to profit. This business is making a loss because the contribution number is lower than fixed cost. Rinku, no, hold it. Why are they making a loss? Because figure of contribution is smaller than the figure of fixed cost. But as the quantity starts rising, the sales figure is rising, the variable cost is rising, the contribution is rising, but the fixed cost is not rising. You are table by table narrowing the gap. It is not difficult to visualize. As the quantity of tables goes on increasing, the contribution figure will go on rising. A stage will come where the contribution will be 10,000 and the fixed cost is 10,000. That is the break-even point. In other words, what I'm trying to tell you is, till such time that an organization's contribution is lower than the fixed cost, organizations make a loss. The point where contribution equals the fixed cost is the break-even point. Where contribution exceeds the fixed cost is where you make a profit. So what is the condition necessary to break even? Contribution should be equal to fixed cost. How much is the fixed cost of this organization? 10,000. How much is the contribution generated by one table? 150. So how many tables should they make in order to generate a contribution of 10,000? What divided by what? 10,000 divided by 150. What is 10,000? 10,000 is fixed cost. What is 150? Is the contribution per unit. So what's the formula for break-even point? Fixed cost divided by contribution per unit. Now we've created the formula. Since you've been involved with the creation of formula, hopefully it's going to stay with you a little longer. How much does the break-even point work out to? It works out to 66.66. So this fellow decides to make 66 tables. Sales of 66 tables at the rate of 250 is 16.5. Variable cost of 66 tables is 6,600. Contribution is 9,900. Fixed cost is 10,000. They're still making a loss of 100. Why are they making a loss of 100? Because the break-even point had worked out at 66.66. So he makes one more table at 67 tables. Sales goes up to 16,750. Variable cost is 6,700. Contribution is 10,050. Fixed cost is still 10,000, and they make a profit of 50. And in case they make the 68th table, sales, VC, contribution, FC, profit. Question I want to ask all of you. Can you please tell me, why is contribution called contribution? The word contribution tells you it's contributing to something. But every table made and sold by this fellow contributes to his top line 250. So why don't we say the table's contribution was 250? Some of you may say, Anil, 250 is gross revenue. To earn 250, the fellow has to spend money. Fair enough. Minus what he has spent. If you don't want to call the top line as the contribution, deduct the expenses and call the bottom line as the contribution. But neither the top line nor the bottom line and in between line is called contribution. Why is contribution called contribution? What is this a contribution towards? Can I hear some of your answers? Why do you think contribution is called contribution? Rahul says it's a contribution to cover fixed costs. Fair enough, Rahul. But at 67 tables, the fixed costs are also covered. Beyond that, no more fixed costs to be covered. But the figure continues to be called contribution. Since we are hard pressed for time, I'm going to carry on, not wait for the answers. Normally, I would have loved to have a chat with you. Rinku says, because the talks not, I think a typo there, Rinku, I'm not following. Answer is, this figure is called contribution because, tell me, what was the bottom line when this company made just one table? 9850. Then they made us negative. Then they made the second table. What is the bottom line? Negative 9700. Tell me, how much did the loss reduce by because the second table was made? Again, it's not going. How much did the loss reduce by? 150, which is the contribution. What was the profit when they made 67 tables? Oops. 50. What are the profit when they made 68 tables? 200. How much did the profit increase by because they made the 68 table? 150. Folks, are you noticing at any point the impact on the bottom line is equal to contribution? And therefore, contribution is called contribution because this is what it contributes to the bottom line. I asked you, do you know your top line? Yes. Do you know your bottom line? No. Folks, if you wish to know your bottom line without waiting for accountants to give you that information, I'm trying to tell you, you got to know your contribution. Historical data you always have. You were making 2 tables. This is history. What is the bottom line? 9700 negative. Now you're making 10 tables. You are the top man. You're monitoring top lines. You want to look at top line and know the bottom line. Can you look at top line and know it? Answer is yes, provided you know your contribution. What are the bottom line of 2 tables? 9700 negative. Now, how many tables have you made? 10. How many extra tables have you made? 8. How much is the contribution of 8 tables at the rate of 150? 8 tables would be 1200. So the bottom line of 2 tables was 9700. Contribution of another 8, 9700 negative. Contribution of another 8 is 1200. If you net off 9700 negative, 1200 positive, you will get 8500 negative. Do you see that number against 10? You can look at the top line and know the bottom line, provided you know your contribution. So folks, what is the break-even point of this company? 67 tables. Let's imagine this entrepreneur has got a fantastic sales team. And very, very soon, his company breaks even. His break-even point is 67. They have sold 100 tables today. Let's work out the profitability of 100 tables, folks. 100 tables, 100 tables at the rate of 250. Sales is how much? 25,000. Variable cost of 100 tables at the rate of 100 is 10,000. How much is the fixed cost of this company? 10,000. Now 10,000 is the fixed cost of 100 tables. So how much is the effective fixed cost per table? Another 100. So what does the table cost this company? 200, or 100 tables cost them 20,000. Folks, this company makes a table at an in-house cost of 200. Their salespeople go and sell it in the market for 250. Every table sold by them, they make a profit of 50. They've sold 100 tables at a 50 rupee profit. Company's bottom line is 5,000, 5 crores, 5,000 crores, whatever. Early morning, this entrepreneur calls a sales meeting, gathers all his sales guys in a room and says, gentlemen, I have good news for you. What is the good news? He says, you people are aware, we are a relatively new table manufacturing company. You guys are also aware our break-even point is 67. He says, I'm very happy to inform you guys, because you have done such a wonderful job. Our company has already broken even in a short period of time. Our break-even is 67. You guys have gone and sold 100 tables. He said, let me share the profitability results with you. He says, we as a company manufacture these tables at an in-house cost of 200. You guys are selling it in the market for 250. Every table sold by you, the company makes a profit of 50. And because you have sold 100 tables at 50 rupees each, our bottom line is 5,000. Right? Everyone clear? Now he tells the sales guys 2 jobs in front of you. Job number 1, go out into the field and carry on the good work that you're doing. And job number 2, he says, we have competition. Now I can see a few names. I'm going to use your names, guys, if you don't mind. There's a Rahul Arora over here. There's a Rinku Shivani over here. He says, let's say we have competition. Rinku is a competitor. He says, go out into the field and see as far as possible, business should come to us, not go to competition. How will you do that? Let's say you're out in the field and you bump into Rahul Arora. And Rahul is a potential customer. And Rahul says, how much is your table for? What are you going to quote to him? Obviously 250. But Rinku is also in the field. And Rinku says, Rahul, I can give you a similar table for 240. Then what do? Then this entrepreneur tells his sales guys, don't watch the competition take the order away. If the competition reduces the price, I suggest you also reduce the price. But he warns them, don't reduce the price to such an extent that we make a loss. I'm not that desperate to deny orders to competition that I make a loss. But so long as we are not making a loss, I am empowering you to play around with prices. Are the instructions clear, guys? What are the instructions given? Go out into the field. As far as possible, sell my tables at the stipulated selling price of 250. However, if competition demands, give a discount, but don't give so much discount that we make a loss. His guys go out into the field. They bump into Rahul. Rahul says, how much is your table for? They say 250, but Rinku also happens to be there. And Rinku says, Rahul, I can give you a similar table for 240. What do you expect? What should this person do? Our entrepreneur salesman, what should he do? Can he afford to quote 230 without violating boss's instructions? Keep giving answers so that I know you're following what I'm saying. Boss said, don't sell it at a loss. At 230, can he afford it? Yes. So when he says 230, Rinku says 220. Can our guy afford to say 210, Vineet? Can we afford 210? Yes. So Rinku says 205. Can our guy say 202? Rinku says 200. Hey, they were high. Rinku says 200. Now to get the order, you'll have to go below 200. What did the boss say? Boss said, so long as you don't make a loss, I'm okay with you playing around with prices. Or let's say at this stage, Rahul interrupts and he says, you know, both of you don't argue. My budget is 150. Whoever wants it, take it. Now tell me, what decision does this salesperson have to take on the field? Should you say yes to Rahul at 150 or no? You know, I have my definition of finance management. Very often people wrongly think finance management is what is happening in finance department. And my answer is the least amount of finance management happens in the finance department. In fact, much of what happens there is accounting. Most finance management or mismanagement happens outside the finance department because every decision of every individual is a financial decision. This decision the salesman has to take, whether to say yes to Rahul at 150 or not. He may call it a sales decision, but folks, don't mistake it. It is definitely a financial decision. It has to be a financially intelligent decision. And it is a combination of such decisions that mean whether your organization makes a profit or not. So folks, I said we have to learn to look at the top line and understand the bottom line. If the bottom line becomes stronger, you should do it. If bottom line becomes weaker, you should not do it. Let's find out what will happen if you say yes to Rahul at 150. What will be the new top line? The new top line will be, oops, what happened? The new top line will be 25, 150, correct? Because the next table is sold for 150. Not important. What is important is what will it do to the bottom line? Hemant says yes to Rahul if the volumes are higher. No, Hemant, volume is one. Rahul wants to buy one table. Dining table hai yaar, बेचने को थोड़ी ले रहा है. Okay, new top line 25, 150. But we are more interested in the bottom line. Tell me, how much is the bottom line of 100 tables? 100 tables bottom line. Guys, I'm so sorry. I don't know why this is happening, but I'm going to. 100 tables bottom line is 5,000. Why is it 5,000? Because the profit per table is 50. Why is it 50? Because this company makes a table at 200, sells it for 250. Profit per table is 50. 100 tables sold at 50 rupee profit. Bottom line 5,000. Is that right? Now, 101st table. When you sell a 200 rupee table for 250, you are earning a profit of 50. Now you have sold a 200 rupee table for 150. Now what has happened? You lost 50 rupees on one table. You earned 5,000 on 100 tables. So bottom line of 101 tables would be how much? 4,950. Has the bottom line of this company become stronger or weaker? Seems to have become weaker. Should you say yes to Rahul or not? Let's find out. New sales 25,150. New VC 10,100. New FC 10,000. New total cost 20,100. New bottom line, not 4,950, folks. It has become 5,050. How? You made a table for 200, sold it to Rahul for 150, and your bottom line has become stronger? How did that happen? Here is where the concept of contribution comes in. What's the formula for contribution? Selling price, less variable cost. How much did you sell this table to Rahul for? 150. How much is the variable cost? 100. On Rahul's order, did you make a positive contribution or negative contribution? You have made a positive contribution of 50. My second question to you was, why is contribution called contribution? We said it contributes to the bottom line. Old bottom line 5,000, Rahul's contribution 50, new bottom line 5050. Can any salesperson afford to say, I don't need to understand this? I'm a sales guy, I'm not a finance guy. Of course you're a finance guy. Every person in your company is a finance person, because finance management is the ability to understand impact on the organization's bottom line of every action of yours. Do all those actions by which the bottom line becomes stronger. Do nothing that hurts the bottom line. But the question still remains, how can you sell a 200 rupee product? You make it at 200, you sold it at 150. How did you make a profit? Is it because the company has already broken even? What happens at break-even point? Break-even point is the point where you have recovered not only the variable cost, but you have also recovered the lump sum fixed cost of 10,000. Beyond break-even point, no more fixed cost to be recovered. Who is Rahul? Is he your only customer or is he your marginal customer? You know, what I'm discussing with you is a topic called marginal costing, and marginal means additional. Rahul is a marginal customer. So long as the marginal customer pays you more than the marginal cost, which is the variable cost, and leaves behind a positive contribution, you cannot go wrong. But tell me, would this logic have worked had the company not broken even? Yeah, can I hear some answers? Would this logic have worked had the company been below break even? While you're giving me answer, let me show you. Let's say they've today not sold 100 tables, they're selling 50 tables. How much is the sales of 50 tables at the rate of 250 each? 12,500. How much is the variable cost at the rate of 100? 5,000. How much is the fixed cost? 10,000. Now 10,000 is the fixed cost of 50 tables. So effective fixed cost per table is how much? 200. Now what does a table cost this company? It costs them 300. Or 50 tables cost them 15,000. Folks, this company makes a table at an in-house cost of 300. They are forced to sell it in the market for 250 due to competition. Every table sold, they lose 50 rupees. They have sold 50 tables, lost 50 rupees per table. Company's bottom line is negative 2,500. What's the scenario today, folks? Scenario is they make a table at 300. They sell it in the market for 250. Lose 50 rupees per table. They sold 50 tables at a 50 rupee loss. Company losing 2,500. Under such circumstances, this company's salesman bumps into Rahul, and Rahul says, you know, I'm very, very keen to buy a table from you, but I've got budgetary constraints, cannot go beyond 150, take it or leave it. Now, should you take it or leave it? Let's apply the same logic. What will happen if you take it? Gentlemen, if the bottom line becomes stronger, say yes. If the bottom line becomes worse, say no. If you take this order at 150, the new top line will become 12,650. Not important. What is important is what will it do to the bottom line. How much is the old bottom line? Old bottom line is 2,500 negative. Why is it 2,500 negative? Because this company makes a table for 300, sells for 250, loses 50 rupees per table. They sold 50 tables at a 50 rupee loss each. Bottom line is 2,500 minus 50 first table. Folks, when they sell a 300 rupee table for 250, they're losing 50. Now they sold a 300 rupee table for 150. Now how much did they lose on one table? 150. So what is the loss of 51 tables? 2,650. Has the loss become more or less? Has the bottom line become stronger or weaker? Seems to have become weaker. Should you say yes to Rahul or no? Let's find out. New sale 12,650. New VC 5,1. New FC 10. New total cost 15,1. New bottom line. Oops. Again, they made a profit. They were earlier on losing 2,500. Now they are losing 2,450. On Rahul's order, they have again made a profit. Now, folks, how did this happen? Last time you told me it happened because they've broken even. Now they haven't even broken even. Folks, I don't remember telling you at any stage in this lecture that contribution is called contribution after break even. Did I ever say that? Contribution is contribution, period. If your contribution is positive, if you're making profits, profits go up to the extent of contribution. If you're making losses, losses go down to the extent of contribution. Folks, this is such critical understanding and literally means the difference between companies that will survive tough days and those that will not. You're already going through tough days. You're already having a dearth of customers. And here a customer walks up to you. Rahul is walking up. You should have rolled out the red carpet to him. And instead of doing that, you say, sorry, Rahul, I can't afford it because I'm going to lose more. Can you afford this ignorance? The only solution is financial literacy on the part of every individual in the company. Expand these numbers to maybe a few crores to see the impact. Your sales was 125 crores, not 12,500. Imagine it's 125 crores. But your cost is 150 crores. This company is losing 25 crores, is bleeding. Every morning, the entrepreneur goes and gives a pep talk to sales guys. Gentlemen, find orders. It's a desperate situation. If you don't bring orders, it's a no-win situation. This company will close down. You guys will lose your jobs. Everybody will suffer. His sales guys go hunting for customers in the field. Rahul walks up to them. I'm interested in buying, but I can't pay more than 150. What's the typical reaction of the salesperson who often proudly says, I'm a non-finance guy? His reaction is, Rahul, tum kya bol rahe ho yaar? Already डूबने की नौबत आ गई है. If I accept your order at 150, कल के बदले आज ही डूब जाएगी ये company. Do you see the crime committed by this fellow against the company? Had you accepted his offer at 150, where you were losing 25 crores, you'd now be losing 24.5 crores. Maybe you're not able to find customers because you're insisting on a price of 250. Maybe if you start accepting more such orders at 150, you'll probably be able to find more customers. You might say, Anil, if I take everybody's orders at 150, my break even won't be 67 anymore. It'll probably become 110. But did you explore maybe it is easier to find orders for 110 tables at a reduced selling price of 150 than it is to find orders for 67 tables at the old selling price of 250? This is also part of your strategizing. Guys, pardon my speed at which I'm going, but the only idea is to take you to a logical end before the time comes to an end. Folks, this is thinking for tough days. Please understand, not for happy days. Happy days, if Rahul had said 249, say not interested. When can you afford to do that? Because when your installed capacity is 10,000 tables and your order book is 15,000, folks, why should you even give him a 1 rupee discount? But your installed capacity is 10,000 and you're manufacturing 1,500 tables. You're paying your workers an 8-hour wage and they are busy for an hour or 2 hours a day. Under such circumstances, saying no to a customer like Rahul at 150 is suicidal, folks. Once again, my apologies for the speed, but thank you so much. Always a pleasure to connect with you. All the names I'm seeing, you're all friends of mine. Haven't met you for a long time, but we must get together sometime. But wonderful, wonderful. Thank you so much.